So what if I told you that the stock market actually has like a hidden physics engine running in the background?
A literal mathematical tax.
Right, a mathematical tax that's quietly siphoning money out of your accounts, even on the days your stocks are going up. Welcome to the deep dive. Today we're stripping away all that veneer of normal financial advice to look at the raw source code of the market.
Because, for most people, when they look at their portfolio, they treat it like simple arithmetic.
Yeah, I mean, the logic is usually just I buy a stock, the company does well, the number goes up. Easy.
Right. Which is exactly how we're trained to think about money from childhood, really. We're taught linear progression.
Like you work an hour, you get paid for an hour.
Exactly. You put money in a piggy bank, the pile grows by the exact amount you put in.
But the financial markets do not operate on linear arithmetic. And that discrepancy is kind of the core mystery we're unpacking today. We have a stack of highly quantitative, mathematically dense research in front of us covering this concept called geometric Brownian motion.
And this invisible force known as volatility drag.
Yes, volatility drag. So our mission for this deep dive is to decode all this intimidating math. We want to translate the quantitative jargon into reality and show you how this hidden tax governs, well, everything. From your standard 401k to the most speculative tech stocks to those highly leveraged ETFs you see people trading all over social media.
And it's crucial to understand up front that this is not some theoretical academic concept.
Right.
Nor is it a hidden fee imposed by a greedy broker. We are talking about a fundamental law of physics applied to compounding numbers. It's an inescapable gravity.
So if you're listening to this on your commute or, at the gym, here's the promise for the next hour. By the end of this deep dive, you will understand why a perfectly balanced buy high, sell low strategy is actually mathematically forced upon some of the most popular funds in the world.
Yeah, it's wild.
You're going to learn why a fund promising 3 times the return is secretly charging you 9 times the penalty.
And we'll uncover why the absolute most mathematically perfect investment strategy, like the exact sweet spot of risk and reward, is almost entirely ignored by Wall Street.
Totally ignored.
Right.
So let's start with the physics of the market itself. Because to understand the tax, we really have to understand the environment.
Right. We have to start with the foundational formula of geometric Brownian motion. In quantitative finance, this is essentially the master equation.
The master equation.
Yeah. It represents how an asset price, whether it's, a single share of stock or an entire index, evolves randomly over continuous time.
Okay, looking at the formula in our source notes here, it is just a wall of Greek letters. Let me read this. S of t equals s sub 0 times an exponential function, and then inside that function, it's just this battleground of variables.
It is a bit dense.
Can you translate this equation into plain English for us?
Sure. Think of S of t as simply the price of your asset today, and S sub 0 is just the price you originally paid for it.
Okay, simple enough.
The exponential function just signifies that we're dealing with continuous compounding interest. But the real secret of the market, the actual engine that drives every single price chart you have ever looked at, is inside that exponential bracket.
Right, inside the bracket.
Yeah. Inside that bracket, you have 2 warring factions, 2 distinct mathematical forces fighting for control of your money every single second the market is open.
So we have a tug of war. What's the first force?
The first faction is the deterministic drift. This is represented by the Greek letter mu.
Mu.
And this is the long-term expected return of the asset. If you buy into a profitable, innovating company or, say, a broad index of the American economy, mu is the fundamental force pushing the stock price upward over time.
So it's driven by actual real-world value creation.
Exactly. Earnings reports, dividends, technological breakthroughs, GDP growth. If there were absolutely no randomness or panic in the world, your stock would simply grow perfectly smoothly along the path of mu.
SOMA is the whole reason we invest in the first place. It's the upward trajectory. But obviously, stocks don't move in a straight, perfectly smooth line.
No, they don't. And that introduces the second faction, which is the random diffusion. This is represented in the formula by sigma times x of t.
Sigma being volatility, right?
Right. Sigma is the volatility of the asset, basically how wildly and violently the price swings from day to day. And x of t is a Wiener process, which in physics is known as standard Brownian motion.
Brownian motion, wait, that comes from observing particles in a fluid, right?
Yes.
Like pollen jittering around under a microscope because water molecules are constantly smashing into it from random directions.
That is the exact origin. Botanist Robert Brown observed that erratic jittering back in 1827, and in quantitative finance, we apply that exact same thermodynamic randomness to stock prices.
That's fascinating. So the water molecules smashing into the stock price are like the unpredictable daily noise of the market.
Exactly. It's the sudden geopolitical news alerts, the Federal Reserve changing interest rates.
Algorithmic trading glitches.
Yes. Human panic, irrational exuberance. It is pure chaotic noise.
Okay, so it's hard to visualize stochastic calculus through audio alone. Let's try to ground this. The deterministic drift, the mu, that's like you're walking up an escalator.
I like that.
You're making steady underlying upward progress because the machine is naturally moving you forward. But the random diffusion, the volatility, is like someone is violently shaking that entire escalator up and down while you are trying to ride it.
That is an excellent visualization. Now, here's where we find the invisible tax.
Okay.
If you look closely at the full equation, the drift component isn't just the pure upward force of mu. It's actually written as mu minus 1/2 sigma squared.
Hold on. Minus 1/2 sigma squared. If someone is randomly shaking the escalator, shouldn't that shaking average out over time?
You would think so.
Right, because sometimes the random jolt throws you upward and sometimes it throws you downward. Why is there a permanent mathematical minus sign attached to the volatility? Like, why does the shaking inherently pull you down?
That negative sign is the volatility drag. In stochastic calculus, it's known as the Ito correction term, named after the mathematician Kiyoshi Ito.
The Ito correction.
Yes, and it exists because of a brutal asymmetrical truth about how percentages work in the real world. Let's step away from the abstract Greek letters for a second and just use physical dollars. Imagine you have a portfolio worth exactly $100.
Okay, I have $100 invested.
A sudden market shock hits. Bad news out of Europe, whatever it might be. Your portfolio takes a massive hit and loses 50% of its value. You're down to $50.
Painful, but okay.
Now the panic subsides and the market recovers. Your portfolio experiences a massive 50% gain.
Right. And the math here is exactly the trap people fall into. Because a 50% gain on my new, smaller base of $50 is only $25.
Precisely.
So I add that $25 back, and I'm sitting at $75. I experienced a perfectly symmetrical percentage swing down 50, up 50, but I permanently lost 25% of my actual wealth.
And to get back to your original $100 from your low point of 50, you don't need a 50% gain. You need a 100% gain.
Wow.
The valley always takes more absolute dollars than the subsequent peak gives back.
Because when you're losing, your base is larger, so the downward percentage wipes out more total dollars. But when you are recovering, your base has shrunk, so the upward percentage buys you fewer dollars.
That is the physical law of compounding numbers. Over time, as a stock price jitters up and down, this structural asymmetry acts like friction. It constantly shaves off a fraction of your wealth.
So this is the invisible math tax. This is the minus 1/2 sigma squared in the equation.
Exactly. The greater the volatility, meaning the bigger the sigma, the more violent the shaking, the larger the mathematical tax you pay just to hold the asset.
So volatility isn't just like a measure of your emotional tolerance for risk. It's an actual physical drag acting against your return. It's literal gravity fighting the upward thrust of your assets' drift.
Yes. Now, for a broad, well-diversified index fund tracking the S&P 500, the historical volatility is relatively low, perhaps 15 or 20% annually.
Right.
So that math tax, that 1/2 sigma squared, is quite small. It exists, but your upward drift, your escalator, easily overpowers the shaking, and you build wealth steadily over decades.
Okay, but if this mathematical tax exists as a baseline reality on normal stocks, we have to look at what happens when people intentionally amplify that volatility.
Oh, absolutely.
Because in the last 10 to 15 years, we've seen an absolute explosion in the popularity of leveraged ETFs. Retail investors aren't just buying the standard NASDQ index anymore. They are flocking to products like TQQQ.
Yes, the 3X leveraged funds.
Right, a fund that promises to deliver 3 times the daily return of the NASDQ 100. So we need to examine the squared penalty of leverage.
This is where the mathematics turn from a gentle headwind into a hurricane. Investors naturally think of leverage as simple multiplication. The logic goes, well, if I take 3 times the risk, I will get 3 times the reward, and I'll probably just suffer 3 times the standard volatility drag.
That sounds perfectly logical.
But the drag does not scale linearly. It scales exponentially by the square of the leverage.
By the square. Let's run the actual math on this so we can see why that happens. If my leverage, which we'll call L, is 3, my expected return, my drift, becomes 3 times MUT. That's the appeal, right? I'm climbing the escalator 3 times faster.
You are. But let's look at the volatility drag formula again. The base formula is -1/2 times the volatility squared. When you introduce leverage to the portfolio, you must multiply the volatility by L before you square the term.
Okay.
So the drag becomes -1/2 times the quantity of L times sigma squared.
Okay, so L is 3. We square the 3 and we get 9.
The drag formula transforms into -9/2 sigma squared.
Oh.
You're taking 3 times the market risk, and you're receiving 3 times the daily drift, but you're now paying 9 times the mathematical tax. Your drag penalty just went up by a factor of 9.
That is brutal.
The sheer brutality of this squared relationship is exactly what destroys so many speculative portfolios.
Let's walk through a discrete day-to-day example to make this undeniably concrete for the listener. Let's compare holding the regular unleveraged NASDAQ crap ETF, which is QQQ, against holding the 3x leveraged version, TQQQ, through just a minor market fluctuation.
Okay, let's set the baseline. Day 0. You invest $100 into the standard QQQ and $100 into the leveraged TQQQ.
Day 1 arrives, and the market has a bad day. The regular QQQ drops by 10%. My $100 becomes $90.
Meanwhile, your TQQQ is legally obligated to triple that daily move, so it drops by 30%. Your $100 plummets to $70.
Okay. Day 2, the market bounces back perfectly to exactly where it started. The regular QQQ goes up exactly 11.01%. And just to clarify the math, for anyone tracking this in their head, 11.01% of $90 is exactly $10. So the QQQ goes from 90 back to a perfect $100. It completely broke even.
Now look at the leverage fund. TQQQ must triple the daily return of the underlying index. The index went up 11.11%, so the leverage fund must go up exactly 33.33%.
All right, so we have $70 in the TQQ account. We need to increase that by 33.33%, which is exactly 1/3. 1/3 of $70 is $23.33. We add that recovery to our $70 base, and we end up with, $93.33.
And there's the structural trap laid bare.
That is insane. The underlying market went down and then went right back up to its exact starting point. It went nowhere. But my leveraged fund, tracking that exact same market, started at $100 and ended at $93 and change. I magically lost nearly 7% of my total capital in 2 days of a completely flat market.
And it is absolutely critical for anyone trading these instruments to internalize this, that 7% loss is not a management fee. It is not a broker commission or a hidden expense ratio skimming your account.
Right.
It is the physical friction of the universe. If you hold a highly leveraged fund in a choppy, sideways market, your money is literally vaporizing into the mathematics of percentage asymmetry. That 9x volatility drag is continuously chewing away at your foundational base.
That is staggering when you actually see the numbers play out. But I have to push back on the mechanics here just a bit. Is this 9x penalty an unavoidable reality of just having leverage? Because what if I approach this differently? What if I bypass the ETF completely, go to my broker, put down my $100 in cash, take out a margin loan for $200, and just buy $300 worth of regular 1x QQQ stock?
Okay.
I have 3x leverage, technically, but I'm just holding standard shares. Am I still suffering a daily mathematical vaporization? Like, is it the leverage itself, or is it how the ETF operates?
That is a highly perceptive distinction. And it brings us to the third critical piece of this puzzle, the daily rebalancing treadmill.
The daily rebalancing treadmill.
Yes. The permanent 9x volatility drag you experience in TQQ is not just an accident of applying leverage. It's a feature explicitly locked into your account by the mechanical structure of the ETF itself.
Let's unpack this daily rebalancing. Why do these funds do it?
A leveraged ETF like TQQQ makes a very specific, legally binding promise in its prospectus. It promises it will deliver 3 times the return of the index for a single day. Not the monthly return, not the annual return, so the daily return.
Daily.
To maintain that strict 3x promise from market open to market close, the fund manager must mathematically reset their exposure every single day, right before the closing bell.
What does that reset actually look like in the market, like functionally?
Let's say the market has a fantastic day and surges upward. The value of the fund's stock assets grows, but the size of its borrowed money, its debt, remains exactly the same.
Because it's a fixed loan.
Exactly. Because the equity grew while the debt stayed static, the actual leverage ratio of the fund drops. It might fall from 3x down to 2.8x.
Oh, I see.
So, To fix this and get back to 3x for tomorrow's open, the fund manager is forced to borrow more money and buy more stock at the end of the day after the prices have already gone up.
They're structurally forced to buy high.
Exactly. Now consider the inverse. The market tanks. The value of the fund's assets shrinks dramatically, but again, the debt remains the same. Suddenly, their leverage ratio spikes dangerously high, perhaps jumping from 3x to 4x or 5x.
Right, because their equity base is getting wiped out, but the loan hasn't changed.
Precisely. If they don't correct this, another bad day could trigger a margin call and wipe the entire fund out of existence. So, to deleverage back down to a safe 3x, the manager must sell off assets at the end of the day right after the prices have crashed.
So they are forced to sell low.
Yes. The daily rebalancing mechanism of a leveraged ETF is institutionalized, automated buying high and selling low. Every single day, the market experiences a volatile swing. The fund manager is executing real trades that lock in a permanent mathematical loss relative to a buy and hold strategy.
Wow.
They're constantly skimming from their own capital base just to keep the leverage ratio perfectly balanced at 3x.
So if we return to my alternate scenario, taking a margin loan to buy standard shares on day one and then just deleting the app, walking away, no rebalancing, I never buy high, I never sell low, do I escape the 9x drag?
If you utilize a no rebalancing static margin portfolio, the dynamic completely shifts. You do not suffer a permanent constant 9x drag. Instead, your drag becomes a non-linear feedback loop.
Let's trace that loop.
Okay, you use your $100 of equity, borrow $200, and buy $300 of stock. You start at exactly 3x leverage.
Right. Okay.
If the stock performs well and doubles in value, your assets are now worth $600. Your debt is still fixed at $200. This means your personal equity is now $400.
Because 600 minus the 200 debt is 4x.
Exactly. You control $600 of assets with $400 of equity. Your actual functional leverage ratio has passively diluted itself down from 3x to just 1.5x.
So as the investment succeeds and I get richer, my leverage automatically shrinks, which means my volatility drag also shrinks back down toward the normal unleveraged level. I naturally outgrow the danger.
You do. You escape the constant 9x tax. But this introduces the apocalyptic alternative.
Oh.
What if the stock goes down? Let's say your $300 of stock drops in value to $220. Your debt remains a hard fixed $200. Your equity is now only $20.
Whoa.
You are controlling $220 of volatile assets or just $20 of equity. Your leverage ratio hasn't stayed at 3x. It has skyrocketed to 11x.
Oh, man. And if the drag is scaled by the square of the leverage, 11 squared is 121. I'm suddenly paying 121 times the normal math tax.
Yes, your volatility drag accelerates toward negative infinity, and if the stock price drops just a fraction of a percent more, your equity hits zero. Your broker issues a margin call, liquidates your position forcefully, and you face total financial annihilation. You are wiped out completely.
So to synthesize this, TQQQ is a daily rebalancing treadmill. As painful as it is actually a built-in safety mechanism.
It is.
It forcefully sells low to guarantee that the leverage ratio never spirals out of control. But the price you pay for that protection against sudden death by margin call is locking in that permanent minus 4.5 sigma squared drag. You're trading the risk of instantaneous annihilation for the absolute certainty of daily chronic bleeding.
That is the precise trade-off.
Which begs the question mathematically, where does a path like that end? If you hold a 3x leverage fund with a massive drag indefinitely, what is the final destination?
Well, if we follow the pure mathematics to their logical conclusion, we arrive at a fascinating and deeply unsettling paradox found in our source material. We can call it statistical heaven versus individual hell.
Statistical heaven versus individual hell. That sounds intense. What does that mean?
It explores a profound philosophical divide inherent in the geometric Brownian motion equation. It's the divide between expected value and the individual path.
How do those differ in this context?
The expected value is the statistical average of all possible paths an asset could take. Imagine we could clone the universe 10,000 times right now and let the stock market run forward for 50 years in each universe.
Okay, a multiverse of portfolios.
Right. The expected value is the arithmetic average of your portfolio's final balance across all 10,000 universes. And mathematically, because the deterministic drift, the mu, of the stock market is positive, the statistical average of all those paths shoots upward to infinity.
Well, the average path going to infinity sounds like a fantastic investment. I definitely want to be part of that average.
The problem is, you do not get to live in the average of 10,000 universes. You are a single human being living in one specific individual universe. You only get to experience one single path.
Right.
And for any single investor living in the real world, the random diffusion component creates a probability shape over time that looks exactly like a trumpet or a megaphone.
A megaphone shape, meaning the cone of possibilities starts very narrow at the mouthpiece today, because we know exactly what the price is right at the second, but as we look years or decades into the future, the cone gets wider and wider and wider.
Exactly. The band of uncertainty expands at a rate mathematically proportional to the volatility multiplied by the square root of time. Now, here's the brutal deterministic truth that the math reveals about that megaphone. We know the drag pulling you down is 1/2 sigma squared.
Yes.
If the upward drift of your asset is less than that volatility drag, if mu is less than 1/2 sigma squared, the deterministic trend of your specific individual path is literally negative. The entire center of mass of that expanding megaphone is pointing straight down into the ground.
Yeah. Wait, I need to process this. How is it mathematically possible that the statistical average of all paths goes to positive infinity while the deterministic trend of almost every individual path goes down to zero? That feels totally logically contradictory.
It feels contradictory because human brains are terrible at comprehending extreme skewness in distributions.
Okay, explain the skew.
Let's imagine a simulation with exactly 100 investors, all holding a highly volatile, highly leveraged fund. For 99 of those investors, the daily volatility drag acts just as the math predicts. It slowly, methodically chews up their capital. They suffer the chronic bleed, and over a long enough timeline, their accounts dwindle to exactly zero.
So 99 out of 100 people are living in individual hell, completely wiped out. So where does the infinite average, the statistical heaven, come from?
It comes entirely from the 100th person. In one incredibly fortunate path out of 100, the random volatility happens to shake perfectly upward at almost every turn. Because of the nature of continuous compounding, that one person doesn't just make a good return, their portfolio goes parabolic.
Like exponentially crazy.
Yes, they make a billion% return. They generate so much astronomical wealth that when you average their single account with the 99 accounts that went to zero, the final mathematical average is still massively positive.
So the expected value is basically a lie. Or at the very least, it's a completely useless, deceptive metric for a human being trying to plan their retirement. The expected value is being pulled up by lottery ticket, astronomical outliers, while the median result, the actual physical path you have a 99% chance of experiencing, is a slow, agonizing bleed to zero.
Yes. If you buy and hold a highly volatile, highly leveraged asset where the drag is greater than the drift, the mathematics dictate that over an infinite timeline, 99.9% of individual paths will end at zero.
All right, I have to play devil's advocate here because anyone listening who has followed the stock market for the past decade is screaming this at their speakers right now.
I can hear them already.
If the math guarantees that high volatility plus leverage equals zero, why hasn't TQQQQ gone bankrupt? It was launched over a decade ago. It hasn't gone to zero. In fact, if you bought TQQQ 10 years ago, you made an absolute fortune.
You certainly did.
So how do you reconcile the absolute mathematical doom you just described with the real-world reality of TQQQ's massive success?
It is the most important question we can ask, and to reconcile it, we have to examine real-world anomalies. The mathematics of geometric Brownian motion assume an infinite timeline and average standardized market conditions. But reality is rarely average.
Right.
For the last 15 years, we have lived through a highly specific macroeconomic anomaly, an extreme, historic, unprecedented technological bull market fueled by 0% interest rates.
So we basically lucked into living in the one universe out of 100 where the market just kept going up.
We lived in an exceptionally fortunate universe. Let's plug the real historical numbers of the last decade into our two warring factions. The tech giants making up the NASDAQ, Apple, Microsoft, Google, NVIDIA experienced explosive, paradigm-shifting earnings growth.
Huge drift.
Massive.
Yeah.
The base drift, the mu for the QQQ index, was historically gigantic, hovering around 18% per year. At the same time, because of quantitative easing and central bank support, we were in a relatively calm macroeconomic environment. The volatility, the sigma, was historically suppressed, sitting at around 20%.
Okay, let's run the math check on those specific numbers. Our rocket engine, the upward thrust of the leveraged fund, is 3 times mu. 3 times 18% gives us 54% upward drift. That is enormous.
It is. Now we calculate the opposing force, the drag. The squared penalty is minus 4.5 times sigma squared. Sigma is 20%, or 0.20. 0.20 squared is 0.04. Multiply that by 4.5, and you calculate a total drag of 18%.
Okay, so the upward thrust is 54%, and the gravity pulling it down, the drag, is only 18%. 54 minus 18 leaves us with a net positive 36% annual return. The massive historical drift of the tech giants was so powerful it simply outran the squared drag.
Precisely.
The escalator was moving upward with such incredible speed that even the violent shaking couldn't pull you backward.
TQQQ survived and generated massive wealth, entirely because the underlying asset possessed a gargantuan, historically anomalous drift that simply overpowered the mathematics of the drag.
But recognizing that brings up a massive red flag survivorship bias.
Absolutely.
Just because we happen to live through a 15-year window where tech stocks defied gravity doesn't mean the mathematical laws are suspended. If we ran this exact same 3x ETF experiment over a 50-year timeline, a timeline that included the prolonged dot-com bust of 2000 or the deep structural grind of the 2008 financial crisis, the drag would eventually catch up, wouldn't it?
It absolutely would. In a prolonged bear market, or even a highly volatile sideways market lasting several years, the negative compounding of the 9x drag would reduce the fund to pennies. And actually, there is another entirely artificial reason TQQQ hasn't gone to zero in a single day.
What's that?
Well, the raw math states that if the underlying index drops 33.4% in a single trading session, a 3x leveraged fund drops 100% and ceases to exist.
Right. 3 times 33.4 is roughly 100. Instantaneous death. Why hasn't that happened during a flash crash?
Because the math assumes continuous, unbroken trading. But human beings built the modern stock market with physical circuit breakers.
Oh, right.
The major stock exchanges are programmed to automatically halt all trading if the broad market drops by 7%. They halt it again at 13%. And if the drop reaches 20%, the exchange simply unplugs the servers and shuts down for the rest of the day.
So it's impossible to hit 33.4% in one day.
Exactly. These artificial physical rules prevent the single-day freefall that would literally zero out a 3x fund in a matter of seconds. The circuit breakers are human interventions, saving the math from its logical, destructive conclusion.
So TQQQ has survived through a combination of a historic tech boom and artificial exchange safety nets, but not all leveraged funds were lucky enough to track the magical NASDAQ through a bull market. What happens when the math actually catches up? Because there has to be a graveyard of funds that didn't have Apple and Nvidia to save them.
Oh, there is an extensive multi-billion-dollar graveyard of leverage. When we look at the leveraged funds that actually blew up and went to zero, they generally fall into two distinct categories of destruction. The first is the single-day black swan.
The sudden death scenario. Tell me about a time that actually happened.
The most infamous example is an event Wall Street calls Volmageddon, which occurred in February 2018.
Volmageddon.
Yeah. The victim was a massive fund with the ticker symbol 8VIX. 8VIX was an inverse VIX fund. The VIX is the volatility index, commonly known as the market's fear gauge. It tracks how much options traders expect the market to swing. The Dicker fund applied a negative 1x multiplier to the VIX. Essentially, investors were betting that the stock market would remain calm and quiet.
And for years leading up to 2018, the market was incredibly calm. People were treating this SPICU fund like it was a high-yield savings account, just collecting steady returns while the market slowly drifted upward.
Exactly. It felt like free money. Until the afternoon of February 5, 2018. Out of nowhere, the market experienced a sudden, violent spasm of panic. The VIX index didn't just go up. It spiked 115.6% in a single trading session.
Oh no, if the fund has a negative 1x multiplier and the underlying index goes up 115%.
The math breaks. A negative 1x multiplier applied to a 115% spike instantly puts the fund's net asset value into negative numbers. The fund was theoretically worth less than zero. This catastrophic breach triggered accelerated liquidation clauses embedded in the prospectus. The fund sponsors forcefully closed it down, wiping out billions of dollars of investor wealth overnight. It was a mathematical execution, completely unpreventable once the volatility spiked past the threshold.
That is the sudden death. What's the other category in the graveyard? The slow death.
We call it the chronic bleed. This occurs in markets that experience extreme volatility but lack the massive upward drift required to outrun the drag. The commodity markets are famous for this. Let's look at March 2020, the onset of the pandemic.
Okay.
There were two very popular 3x leveraged oil ETNs, UWT and DWT. One bet on oil going up, the other on oil going down.
March 2020 was unprecedented. Oil demand completely vanished overnight. Prices went crazy. What happened to the funds?
Well, oil prices dropped roughly 30% in a single day. The 3x fund trading it instantly dropped 90%. So immediately you are operating on a tiny smashed base of capital. But the real killer was what happened next.
What happened?
After that initial drop, the global oil market entered a period of massive, chaotic, daily volatility. Huge swings up, huge swings down.
The violent shaking of the escalator we talked about earlier?
Yes, but amplified by 3. The squared drag that 9x mathematical tax kicked into overdrive. Even on days when the oil price rebounded, the daily rebalancing treadmill inside the fund forced the managers to buy high and sell low in a highly erratic market. The volatility simply chewed up whatever capital was left.
Just ground it to dust.
Exactly. Within a matter of weeks, the sponsoring bank, Citigroup, had to forcefully delist and close the funds because the compounding math was relentlessly driving the share price to absolute zero.
That makes me incredibly nervous about a new trend in the market. Recently, we've seen a flood of single-stock leveraged ETFs. Like, you can now log into a brokerage and buy a 2x leveraged Tesla fund.
And mathematically speaking, those single-stock leveraged funds are perhaps the most dangerous instruments available to retail investors. An index like the NASDAQ has lower overall volatility because it's an average of 100 different companies. The calm stocks balance out the chaotic ones.
Right.
But a single company, especially a highly speculative one like Tesla, already possesses a massive base volatility. It swings wildly all on its own.
Right. I mean, it can drop 10% on a single tweet.
Exactly. And if you take a high base volatility and square it, the math tax becomes astronomical. A 2x leveraged individual tech stock might be generating a 70% annual volatility drag, purely through the friction of maintaining its daily leverage ratio.
70%.
You would need the underlying stock to practically double every year just to break even against the math. It's a mathematical meat grinder designed to extract wealth from retail traders.
Okay, so leverage squares the damage. That is clear. But it makes me wonder, is this volatility tax only a danger if you use leverage? What if there's no leverage involved at all? If a stock is just naturally, inherently chaotic, does the math tax still eat it alive?
It absolutely does. This is a crucial realization. Regular 1x unleveraged assets can be completely destroyed by volatility drag if their internal expected return is too low to outrun the chaos of the price swings. This introduces us to the unleveraged victims of the math tax.
Give me an example of an unleveraged victim.
The most glaring modern examples are meme stocks and speculative penny stocks, the ones you see promoted heavily on social media message boards.
The stocks that shoot up 200% in a week based on a rumor and then crash 80% the next month.
Let's apply the geometric Brownian motion map to one of those companies. Suppose a junk stock actually has a legitimate new product and a rational expected return of 20% a year. So the drift, mu, equals 0.20. That's a great return.
Yeah.
But because it has become a meme stock, the retail trading frenzy creates a chaotic, terrifying volatility. Let's say the annualized volatility, the sigma, is 120% or 1.2.
Okay, let me run the Ito correction formula. The drag is 1/2 times sigma squared. 1.2 squared is 1.44. Half of 1.44 is 0.72.
Now, subtract that 0.72 drag from your fundamental expected return of 0.20.
0.20 minus 0.72 equals negative 0.52.
Precisely. Even with absolutely zero leverage, the stock organically loses 52% of its value every single year, purely through the friction of its chaotic price swings.
Wow.
The underlying business might be growing at a healthy 20%, but the sheer violence of the trading volatility is destroying 72% of the value. The stock is mathematically forced to bleed out. This is why highly volatile penny stocks almost universally trend downward towards zero over a multi-year timeline, entirely regardless of the underlying company's fundamental performance. The volatility kills them.
Are there serious institutional funds that suffer from this unleveraged decay, or is it just meme stocks?
Oh, there are serious funds. Look at UNG, the United States Natural Gas Fund. It's a completely standard 1x unleveraged ETF. Yet if you look at a long-term chart, it has lost over 90% of its value since its inception. The fund managers have had to execute multiple reverse stock splits just to keep the share price from hitting zero.
Why would that happen? Natural gas hasn't gone to zero. The economy still relies on it to generate electricity and heat homes.
It happens for two compounding reasons. First, the natural gas commodity market is inherently one of the most volatile markets on Earth, driven by unpredictable weather patterns. So the baseline volatility drag is already incredibly high. Second, and more importantly, the UNG fund does not hold physical tanks of natural gas. It holds financial futures contracts. And the natural gas futures market frequently exists in a structural state called contango.
Contango. I've heard traders use that word. What does it actually mean for the fund?
Contango means that the futures contracts for next month are priced higher than the contracts expiring this month. This happens because storing physical natural gas costs money. You have to pay for the pipelines and the storage tanks.
Right.
So every single month, when the UNG fund has to roll its position forward, meaning it must sell its expiring contracts and buy the new ones for the next month to maintain its exposure, it is forced to sell the cheaper contracts and buy the more expensive ones.
I see. So if they sell the front month at $2 and have to buy the next month at $2.10, that 10 cents of value just evaporates from the fund's net asset value every single time they roll.
Exactly. This mechanical loss creates a permanent, structural, negative drift. Your mu is inherently negative before the market even opens. When you combine a negative fundamental drift with a massive volatility drag, you create a mathematically certain death spiral. A chart of UNG over 10 years is essentially a visual representation of an asset slowly melting into the earth.
Hearing you describe this decay, a negative drift combined with time slowly eroding the value, it sounds exactly like trading options. Does the math of volatility drag apply to the options market?
It doesn't just apply. Options are the ultimate, purest physical embodiment of this exact mathematics. The geometric Brownian motion equation we've been discussing is the foundational bedrock of the Black-Scholes model, which is the formula used to price options globally. The concepts map over perfectly.
Walk me through that mapping. What represents our upward engine, the drift in the options world?
The drift maps directly to the options Greeks, known as delta and gamma. Delta measures how much the option price moves when the underlying stock moves. Gamma measures the acceleration of that movement. That is your engine. When you buy a call auction, delta and gamma are what you rely on. You need the stock to move fast and hard in your predicted direction to generate wealth.
And what represents the volatility drag, the math tax pulling you down?
The volatility drag is literally theta, commonly known as time decay. Every single day that passes, an option loses a small fraction of its value simply because time has elapsed. That decay is the exact same physical force as the -1/2 sigma squared drag. An option derives its value from the uncertainty of the future. As the expiration date approaches, that uncertainty shrinks, and that shrinking certainty is mathematically taxed out of your premium.
This perfectly explains a phenomenon that frustrates so many retail traders, 5E crush. Implied volatility collapse.
Oh, yes.
You see it constantly around corporate earnings. A trader will buy a call option the day before an earnings report, hoping for a massive jump. The company reports record profits, the stock shoots up 5%, but when the trader checks their account the next morning, the value of their call option has plummeted. They lose money even though they predicted the direction perfectly. Why?
Because when you buy an option the day before an earnings report, you're purchasing it when market uncertainty is at its absolute peak. You are paying a massive premium for extremely high implied volatility. The sigma in your equation is enormous.
Right.
But the second the earnings numbers are released to the public, the mystery is solved. The uncertainty vanishes instantly. The implied volatility, the sigma, collapses. And because the options price was heavily inflated by that volatility, the price implodes. This is IV crush. You might have been right about the directional drift, but the sudden, violent collapse of the volatility premium completely wipes out your value. It's the volatility drag, accelerating to light speed in a single moment.
Okay, let's pull all of this terror together. Leverage multiplies the math tax exponentially. High volatility alone can kill a completely unleveraged asset, and options have built-in expiration dates that are physical manifestations of this decay. It makes me wonder, is there a solution to this?
There is.
If 3x leverage is suicidal over the long run, but 1x unleveraged investing leaves potential growth on the table, is there a mathematically perfect amount of leverage, like an exact optimal peak that an investor should use?
There is an exact peak. And finding it involves one of the most elegant and powerful formulas in quantitative finance. It's known as the continuous time Kelly criterion. The formula to find your exact optimal leverage is breathtakingly simple. L star equals mu divided by sigma squared.
L star being the optimal leverage ratio, mu divided by sigma squared. Can you explain the geometry of that? How does that formula shape a portfolio's growth?
Think of the long-term compounded growth of your portfolio as an upside-down parabola, like the shape of a massive arch. As you increase your leverage from 1x to 1.5x to 2x, your long-term returns begin to climb. You're walking up the left side of the arch, the extra drift is helping you.
You okay?
But remember, the volatility drag is growing by the square of your leverage. Eventually, that square drag catches up and begins pulling your returns downward. The absolute top of that arch, the single highest peak where your geometric compounding returns are maximized before the drag overwhelms them, is the Kelly point.
Let's apply this to the real world. If we look at the historical data for the overall market, the S&P 500, what is the optimal leverage? Where is the top of the S&P 500's arch?
If you factor in the historical century-long drift and the historical volatility of the S&P 500, the Kelly formula places the optimal leverage point right around 3.9x.
Wow, 3.9x, that is significantly higher than I expected.
It is high because the S&P 500 is a highly diversified index. It possesses the very steady upward mu and a relatively low historical sigma. The math dictates that you can safely apply a substantial amount of leverage before the square drag becomes fatal. But now let's run those exact same calculations for the NASDAQ, the tech-heavy QQQ index.
Tech stocks grow faster, so they have a higher drift, but they are notoriously much more volatile. The shaking of the escalator is much more violent.
Exactly. And recall the formula, mu divided by sigma squared. Because that higher volatility figure gets squared in the denominator, the mathematical penalty is severe. For the historical NASDAQ, the top of the arch drops significantly. The absolute optimal maximum leverage is roughly 2.6x.
Wait a second. The mathematical historical peak of optimal returns for the NASDAQ index is 2.6x leverage.
That is correct.
But Wall Street's most famous, most heavily traded leveraged tech fund is TQQQ, which applies exactly 3x leverage. Wall Street is explicitly designing and selling a product that is mathematically past the historical optimal peak of the asset it tracks.
That is the grand structural irony of the retail financial system. Anyone holding TQQQ as a long-term investment isn't just taking on more risk for more reward. Mathematically, based on historical averages, they are operating on the downward slope of the parabola. They're accepting vastly more volatility and more risk of total ruin for less long-term compounded return than if they were simply holding a 2.6x fund or even a 2x fund.
What happens if an investor ignores the math entirely and keeps walking down that right side of the parabola? What if someone creates a 5x or 10x leveraged ETF?
They will eventually step off what quantitative analysts call the cliff of ruin.
The cliff of ruin.
Yes. The parabola crosses back over the zero return line exactly at double the optimal leverage point. So if the optimal peak for the NASDAQ is 2.6x, double that is 5.2x. If you leverage the NASDAQ at 5.2x or higher, your long-term expected geometric return drops permanently into negative numbers. It does not matter if the underlying market is in a massive bull run. The sheer mathematical weight of the squared volatility drag will guarantee that your portfolio bleeds to absolute zero over time.
This realization creates a massive logical gap for me. If 3.9x is the optimal historical leverage for the S&P 500, that means a 2x leveraged S&P 500 fund is sitting safely on the left side of the arch. It is climbing steadily toward the peak without getting dangerously close to the cliff of ruin.
That's right.
Mathematically speaking, a 2x S&P 500 ETF should be the absolute holy grail of investing for anyone with a long-term time horizon. So why is nobody talking about SSO? SSO is the primary ticker for the 2x S&P 500 ETF. It gets almost zero press, it's never bragged about on message boards, it is a ghost compared to the massive trading volume of TQQQ.
This brings us to the tragedy of SSO. To understand why the most mathematically optimal rational fund is largely ignored by the market, we have to look at the intersection of human behavioral finance and the structural mechanics of Wall Street profitability.
Let's start with human behavior. Why do retail investors reject the mathematically optimal path?
I refer to it as the lottery effect. The vast majority of retail investors do not open brokerage accounts to achieve optimal invisible geometric compounding over a 30-year horizon. They're seeking action. They want the dopamine hit of immediate validation.
Right, the thrill of the casino.
Exactly. TQQQ, with its massive 3x swings applied to highly volatile tech stocks, provides that thrill. It can jump 5% or 10% in a single trading session. SSO, because it tracks the broader, much slower S&P 500 at only 2x leverage, is simply too boring for the retail day trading crowd. It does not offer the lottery ticket upside they were addicted to.
I understand why the gamblers ignore it. But what about the conservative long-term index fund investors? They love the S&P 500. This is just a slightly accelerated version of it.
Because to a conservative buy-and-hold investor who lived through the trauma of the 2008 financial crisis, the mere concept of applying leverage to their retirement nest egg is terrifying. It violates their core principles of safety. So SSO is trapped in a structural catch-22. It's deemed too volatile and risky for the conservative indexing crowd, yet too sluggish and boring for the speculative day traders.
But what about the institutions? Wall Street ETF providers employ the smartest quants in the world. They know the Kelly criterion. Why don't they market SSO heavily to the public?
Because the mechanics of Wall Street dictate that ETF providers generate their revenue through trading volume and management fees. The massive erratic daily swings in TQQQ attract an army of high-frequency algorithmic traders, arbitrageurs, and retail day traders. That creates gargantuan daily trading volume. High volume creates deep liquidity, which narrows the bid-ask spreads, which in turn attracts even more institutional traders. It creates a highly profitable positive feedback loop for the ETF provider. They make an absolute fortune administering TQQQ. SSO simply does not generate the frenetic trading velocity that Wall Street requires to justify massive marketing campaigns.
What about the hedge funds, the smart money? Why aren't they buying up SSO if it's mathematically optimal?
Because hedge funds are far too sophisticated to pay the retail fees associated with ETFs. SSO carries an expense ratio of around 0.87%. Furthermore, to achieve that 2x leverage, the ETF must enter into swap agreements with major investment banks, and those swaps carry hidden financing costs tied to floating interest rates. A multi-billion-dollar hedge fund is not going to accept a 1% structural drag just for the convenience of holding an ETF. Instead, they access the derivatives market directly and purchase E-mini S&P 500 futures contracts. They can expect the exact same optimal leverage curve for fractions of a penny in fees. SSO is a product built specifically for retail investors, but the retail investors either don't want it or don't understand the math behind it.
Okay, this brings us to the most practical, actionable question of this entire deep dive. If you're a listener tracking with us and you understand the math and you realize the 2x S&P 500 is optimal, should you log into your 401k tomorrow morning and move your entire life savings into SSO to ride that optimal math curve?
Let me be as definitive and clear as I possibly can be. Absolutely not. Under no circumstances should a retail investor do that.
That is a very firm warning. But you just spent 10 minutes explaining how it was mathematically optimal. Why shouldn't we do it?
Because the Kelly criterion is a theoretical mathematical construct. It assumes two things that are not true for human beings. It assumes you have an infinite time horizon to allow the probabilities to play out, and it assumes you will never, ever need to withdraw money during a drawdown. Real human lives do not function that way.
Right. I am not an immortal entity. I am going to need to retire and access that capital at a specific date.
Exactly. Let's look at a real-world stress test. During the 2008 financial crisis, the S&P 500 dropped roughly 55% from peak to trough. If your entire retirement account was 100% leveraged in SSO, mathematically, 2 times 55% is a 110% drop.
Which means I lose everything. My account goes to zero and I owe the broker money.
In reality, because of the daily rebalancing mechanism preventing total margin calls, you wouldn't owe the broker money. But the compounding decay would cause your fund to functionally drop by 90 to 95%. You would lose virtually your entire life savings. Now, recall the percentage asymmetry we discussed at the very beginning. If your $500,000 retirement account drops to $25,000, you suffer a condition known as base deadlock. Your principal base is now so microscopically tiny that even if the market immediately enters a historic, decade-long bull run, the absolute dollars you gain will never recover your original wealth within your remaining human lifespan. You'll be permanently wiped out exactly when you need the capital the most.
So the math of the Kelly criterion is theoretically optimal, but applying it at 100% in the real world is suicidal. What is the practical solution? How do quantitative professionals actually use this knowledge safely?
They use a risk management concept pioneered by the smartest quantitative hedge funds. It's called the half-Kelly strategy.
Half-Kelly, meaning you deliberately target exactly half of the mathematical optimal leverage.
Precisely. If the absolute peak of the mountain is 4x leverage, walking right on the razor's edge of that peak is entirely too dangerous. A strong, unexpected gust of wind like the 2008 crisis or the 2020 pandemic crash will blow you backward off the cliff of ruin. So instead of aiming for the peak, you aim for halfway up the mountain slope. Mathematically, the half-Kelly point provides roughly 75% of the optimal compounding returns, but it exposes you to only a tiny fraction of the catastrophic drawdown risk. It is the true sweet spot of survival and growth.
How does a normal retail investor execute a half-Kelly strategy inside a standard 401k or IRA?
You utilize a core satellite portfolio approach. You do not put your entire account into the leveraged SSO. Instead, you keep 80 to 90% of your capital in a standard, unleveraged, low-cost S&P 500 index fund like SPY or VOO. This serves as your impenetrable core. It suffers zero volatility drag from leverage, and it charges microscopic management fees.
And the remaining capital becomes the satellite.
Yes. You take the remaining 10 to 20% of your portfolio and allocate that into the 2x leveraged SSO. By combining these two positions, you give your overall portfolio a blended leverage ratio of perhaps 1.1x or 1.2x. It's a very slight, deliberate tilt. You're nudging your overall portfolio slightly to the left on the parabola, capturing a bit more upward drift while keeping the squared volatility drag mathematically negligible.
And doing this inside a 401k or an IRA provides a massive structural advantage because it's a tax-free environment.
That is the secret weapon of the strategy. You use the tax-free environment to forcefully and mechanically rebalance the portfolio. When a market crash inevitably occurs, your SSO position will take a severe beating. Your 80-20 allocation ratio will drift to something like 90-10. That is your signal to rebalance. You sell off a portion of your safe, unleveraged SPY, and you use that cash to buy the heavily discounted SSO. You are mechanically forcing yourself to buy low when there is blood in the streets.
And the inverse happens during a bull market. When the market is booming, the SSO position will double or triple in value rapidly, skewing the ratio the other way, maybe to 7:30. So I sell off the massive profits from the leveraged SSO, and I move that cash back into the safe, boring SPY core. I am mechanically forced to sell high and lock in the gains.
It completely removes human emotion from the equation. It forces mathematical discipline. By actively rebalancing, you're actually harvesting the volatility to your advantage rather than allowing the drag to destroy you. That is how sophisticated investors survive and thrive using this mathematics.
I love that practical takeaway. It takes this incredibly high-level, abstract, stochastic calculus and grounds it into a highly actionable strategy. But before we wrap up, I want to satisfy one lingering, mind-bending mathematical paradox from the source notes. It's been bugging me since I read the research, and we need to do a deep math reality check on the concepts of discrete versus continuous time.
You're referring to the geometric mean versus median paradox. This is the exact point where human intuition goes to die. Let's walk through it.
Okay, here is the issue. In the source material, the academic papers state definitively that in a geometric Brownian motion environment, the geometric mean of the asset's price is exactly equal to the median of the distribution. And my rational brain completely rejects that claim. Let me present my logic. If I take three discrete numbers in the real world, let's say the numbers 1, 2, and 100.
Okay, a highly skewed data set, 1, 2, and 100.
If I ask a middle student for the median, the middle number of that set, the answer is obviously 2.
Correct. Half the numbers are above it, half are below it.
Now let's calculate the geometric mean of that same set. To do that, I multiply the three numbers together. 1 times 2 is 2. 2 times 100 is 200. And because there are three numbers in the set, I take the cube root of 200 to find the geometric mean.
Which calculates to approximately 5.85.
Exactly. The median is 2. The geometric mean is 5.85. They're unequivocally not equal. They're not even close to each other. So how can these quantitative PhDs boldly claim in their papers that the geometric mean and the median are perfectly equal?
I applaud your logic. Your calculation is absolutely correct in the discrete world, the world of whole numbers and chunky human-scale time steps. In discrete data sets that are highly asymmetrical, like your example of 1, 2, and 100, where the massive 100 outlier pulls the entire mathematical average to the right, the geometric mean does not and cannot equal the median. Logarithmic transformations warp symmetry when applied to discrete, real-world data points.
Okay, so if my logic holds up, why do the quantitative models insist they are equal? Where is the disconnect?
The disconnect is resolved by what we call the continuous leap. Geometric Brownian motion does not deal with three discrete, chunky numbers. It relies entirely on the concept of continuous time and the power of the central limit theorem. I want you to imagine slicing time, not into years or days or even seconds. Imagine slicing time into infinite, microscopic, subatomic fractions of a second. Millions upon millions of tiny, random mathematical coin flips happening continuously, forever.
Okay, I'm picturing a perfectly smooth, continuous flowing line instead of a jagged staircase of daily closing prices.
When you apply infinite microsteps to a random walk, the central limit theorem takes over the mathematics. It dictates that the final prices, when viewed purely in logarithmic space, meaning when you take the natural log of all the possible prices, they are mathematically forced to form an absolutely perfect, flawless, symmetrical, normal distribution. A perfect bell curve.
Okay, I remember from statistics class that in a perfect, flawless bell curve, the arithmetic mean, the median, and the mode are all located at the exact same point, right in the dead center of the curve.
That's it. In the theoretical log space, the mean and the median share the exact same coordinate because of absolute mathematical symmetry. Now, here's the final magic trick to resolve the paradox. We don't trade stocks in log space.
Mm.
We need to translate that perfect center point back into normal real-world dollar prices. We execute that translation using the exponential function.
P to the power of whatever the log value is.
Right. And the exponential function possesses a very unique and vital mathematical property. It is perfectly monotonic.
Monotonic. Can we define that for the layman?
It's a formal way of saying that the function never ever changes the rank order of the numbers it processes. If variable a is larger than variable b before you apply the exponent, variable a is mathematically guaranteed to still be larger than variable b after you apply the exponent. The function stretches the absolute distances between the numbers exponentially, but it never shuffles their place in line.
Okay, I am following the logic. The rank order remains perfectly intact.
Because the function does not shuffle the order, the specific number that represented the median, the exact 50th percentile middle rank in the log space, remains the exact 50th percentile middle rank when you translate it back into dollar prices. But because we mathematically define the geometric mean as the exponential of the log mean, when we translate that perfectly symmetrical center point back into the real world, the geometric mean perfectly flawlessly lands on the exact same dollar value as the median.
Oh, wow. So the paradox only exists because human brains think in chunky, discrete numbers. But in the infinite, continuous math of the universe, the geometric mean and the median are literally the exact same mathematical point, just viewed through different theoretical lenses.
Precisely. You have bridged the gap between intuition and stochastic calculus.
This gives me a massive practical revelation about how I view the market. When I open up my brokerage app or look at Yahoo Finance and I pull up a 10-year stock chart, that squiggly line I'm looking at on the screen is not showing me the arithmetic average of the stock's returns. If it were showing the arithmetic average, the chart would be skewed astronomically higher by those insane 1 in a million outlier paths we talked about earlier.
That is deeply profound and entirely correct. You are never looking at the arithmetic mean on a stock chart.
What I am actually looking at, physically rendered on my screen, is the geometric reality. That line represents the exact median path. It's a specific trajectory that, if I played this investment game a million times in a million universes, I have exactly a 50-50 chance of beating and a 50-50 chance of losing to. The chart is showing me the raw reality of the asset after the invisible math tax of volatility drag has already been extracted.
That is beautifully synthesized. The historical price chart is the physical, visual representation of the geometric mean, which is the inescapable median reality of the market. It is the truth stripped of all statistical illusions.
Wow. We have covered an immense amount of incredibly deep ground today. We started by identifying and defining the invisible math tax, the volatility drag, that -1/2 sigma squared that acts as gravity, constantly pulling against your upward progress.
The violent shaking of the escalator.
We looked at the extreme danger of strapping a multiplier to that escalator. We revealed how leveraged ETFs like TQQQ don't just multiply the drag, they square it, creating a punishing 9x penalty that locks you into a daily treadmill of buying high and selling low. We explored the vast graveyard of complex options, meme stocks, and VIX funds that were chewed to dust by this math.
We discovered the mathematical limit of human greed using the Kelly criterion, revealing the profound irony that Wall Street's most popular 3x leveraged funds are actually operating past the historical optimal peak of the market.
And finally, we brought it all down to earth, explaining how you can safely navigate this treacherous physics engine using a disciplined half-Kelly core satellite strategy inside a tax-free 401k, keeping your capital safe while still harnessing the power of the upward drift.
It is a tremendous amount of abstract theory to process. But understanding these unseen forces is precisely what separates the emotional gamblers from the rational investors. I want to leave you with one final provocative thought to mull over. We spent the last hour talking about volatility drag as a strict financial formula, but it's vastly more profound than that. It is a universal law of nature.
Oh, of nature.
Think about biology. Think about the grand scale of evolutionary history. A species with a slow, steady, low volatility mutation rate, like a shark or crocodile, survives in the oceans for hundreds of millions of years. Their upward drift is steady and their evolutionary drag is incredibly low. Now imagine a species with wildly volatile, unpredictable, rapid genetic mutations. They might adapt incredibly rapidly to a highly specific environment. They might dominate their ecosystem for a generation or two, experiencing massive growth, just like TQQQ dominated the anomaly of the 2010s tech boom. But eventually, inevitably, the macro environment changes. An ice age comes or an asteroid hits, the volatility backfires. The squared drag of a fatal extreme mutation in a new environment wipes them out entirely. Nature, just like the stock market, brutally and relentlessly punishes extreme variance over the long run. Survival of the fittest is, mathematically speaking, survival of the highest geometric mean. So the next time you open your portfolio and look at a wild, highly volatile investment, or the next time you're tempted by the dopamine rush of a 3x leveraged fund, ask yourself a fundamental question.
Are you building a resilient portfolio designed to be the steady, ancient survivor of the ecosystem?
Exactly.
Yeah.
Or are you simply setting yourself up to be a temporary, spectacular spike in someone else's statistical heaven?
That is a chilling, perfect perspective to end on. Thank you for joining us on this deep dive. Take a hard look at your portfolios, respect the volatility, and never forget the math tax. We'll see you next time.